we're going to go through the adjusting entries that are typical. The first one is an accrual, and that accrual is for revenues that have been earned. So what we're going to do is at the end of the accounting period, the company's going to have to figure out what all it hasn't recorded yet that it has earned, even if it hasn't been, of course, collected or billed. The revenue recognition principle is what allows them to do that, and the rule is that you record revenues when it's earned, regardless if it's been collected or billed, regardless if it has not yet been collected or billed. So what we're going to do here is assume this company has Know-It-All has 5,000 in receivables because it provided 5,000 of services on account. This is during the period, or during the month of May, we'll say. And let's say it collected 3,500 of those receivables. So they had debited cash, which I don't show you here, but they've credited accounts receivable. Now they're at the end of the accounting period, and the accounting department has to figure out all that's been earned that they haven't yet recorded. And let's say it finds out that at the end of May it had earned $500 just recently, and they will be billing it in June and collecting it either at the end of June or even in July. So knowing that, an adjusting entry has to be made. The entries will be made on May 31, and what they're going to debit is accounts receivable because they're to receive that money, and what you credit is sales. Then you, of course, after you make any entry in the journal, you post it to the ledger. So we will go ahead and debit the accounts receivable and credit the sales. So as we've seen before, accounts receivable goes up when you have sales on account and goes down when you collect it. Now the tally of these accounts will be 2,000 is what is yet to be received from our customers, and Know-It-All has earned 5,500. Now what's important to know is that you've got sales revenue on your income statement, because your income statement, remember, is prepared by getting all your revenues minus all your expenses, and we'd have revenues here of 5,500. That amount represents what you earned. It tells you nothing about what you've collected. In fact, you can see here that we haven't collected it, and so again, it's your sales or your revenues on your income statement will not equal the cash collected from customers. What's going to be linking the two together, explaining why the amount earned differs from what was collected, you'll see accounts receivable on the balance sheet, and that represents the timing difference. In other words, all this will eventually get collected, but in the meantime they've only collected 3,500. They're going to collect the rest of it in June or even July. So that's accrued revenues.